All right, we're live. What's going on, my fellow wealth creators? Matty Ice here. We've got what I think is a pretty important video. We are going to be talking about what you need to pay attention to when it comes to IUL policy design and stuff like that. And Michael here from IC Life has been kind enough to give us some of his time and go through a policy that he shared on Facebook the other day, just as an example of how terrible these things can be, right? It was I don't know about you, Michael, but that was probably one of the worst IUL policies that I have seen since I started doing this. And it's just so frustrating, man, because like I think about the client probably was sold a bag of goods about how amazing this product is. And he when looking at the illustration, probably didn't really exactly know what he was looking at, just kind of whatever the agent was telling him. You're going to get all this upside potential, downside protection, and tax-free retirement income and stuff. But it was awful. I mean, absolutely awful. So what I want to do, I want to, so first off, maybe, talk to us about, how were you introduced to this client? How'd you even come across this policy? And then have you share your screen. We'll actually break down the policy so that people can see what they need to look for. Like if you're considering an IUL and you're looking at illustrations and stuff, what are some specific things that people can look for to help them determine if this is maybe not designed as optimally as it should be for their specific goals and stuff like that. I want, at the end of the day, people to be aware of the risks involved with these products, especially if they're not designed correctly. So the floor is yours, my friend.
Yeah, no, I appreciate it. We've gotten a lot of great feedback from sharing this policy. I think you shared it, another agent shared it, and a few agents have shared it. And we've gotten people reaching out saying, man, I was about to buy this, or I was going to put my whole retirement in fact, one person was going to put their whole retirement, $1.1 million into one of these. And they reached out and started asking questions like, hold up. Right. And so we probably just saved that person at least half their retirement as far as what they're going to be able to use going forward. Right. And so it's a big deal. We see these things all the time. And the reality is agents are selling these things. I actually just saw a post, Matt, and it was, you might know Q, but he said there are two types of life insurance. There's term and there's whole life. Right. And I mentioned, take it a step further and you think about, okay, well, what type of insurance is IUL? Right. And it's often sold as a whole life policy or a permanent
or
policy.
Alternative, like a better evolved version of it. Right.
Right. And the reality is it's a flexible annual renewable term policy. Right. And the idea behind it was
with an interest crediting strategy. That's it.
Right. And so when you look at it through the right lens as a term policy, as something that's not permanent, it's actually pretty hard to criticize if you're doing it right. But when you look at it as a permanent policy and as a retirement, that's when things start to fall apart. Right. And so unfortunately, this came in a file that was actually labeled whole life. So
really?
Yeah.
How did you come across the file? Why was it originally sent to you?
Yeah. So this came about, I have a friend in real estate and we actually found a policy. She had she had a minimum funded universal life policy. And to get out of this policy, it's going to cost her $56,000.
My gosh, man.
$56,000 to get out of this policy. Yeah. And so, obviously, realizing, she was getting ripped off. She decided to, she's definitely a believer in what we do in insurance. And she wanted to tell people. So this is actually a referral from her. And so I got this policy, and it was another minimally funded UL. This time, in this case, it was an IUL policy, minimally funded, and it's crazy. It's crazy what you see.
And the other thing you mentioned too that I think is crazy as well. Like you mentioned that we see this all the time, and it's true. I haven't seen very many good IUL policy designs and stuff. Like you've had conversations with IUL agents that know what they're doing. I've had them as well. They're few far in between, man. Like, and I see this comment from advocates of IUL all the time. Well, it's just a horrible policy design. And I see that from every agent that like makes comments about it and stuff. But it's like, okay, well, if every agent knows how to, apparently every agent knows how to design these policies, like all these IUL agents are saying, that's just bad policy design. Why are there so many bad policy designs, dude? This is just nuts. I don't see very many good designs. And then even when they are designed correctly, I'm still not a fan. And I was like, well, you know, obviously this is a problem, and we need to bring more attention to it because people are getting hurt. You just said that one lady, your one client, $56,000 to get out of a universal life policy. And when we look at this current IUL policy, how much is it going to cost this client? Like, it's just absolutely egregious. And I did want to say one other thing as well. I really, really appreciate you sharing that, because when I saw it, I mean, you know, you and I we're used to seeing those types of things, but that was like, it was really bad. And then I made a video about it. And Michael, I'll tell you, I got off the phone with I called a marketing client of mine a couple days ago, and I was calling him about this partnership program for this product that we're promoting. But when we got on the call, he said, before we talk about that, I saw your video about index universal life insurance the other day, and it's crazy you posted that because I'm about to buy one. And it's like just like that ripple effect, you know. It's why I'm so passionate about doing this, and why I think it's so important to expose these types of things and let people know, like, look, this is not what you think it is. Because he was going to dump, I don't know exactly how much, but a pretty decent amount, I would imagine, because he wants to provide a legacy for his 5 grandchildren. But I started asking him, hey, did your agent explain the risk? Did he explain how this part works, the difference between cost of insurance and amount at risk? Did he tell you that it's on annual renewable term and the risk of taking policy loan and all this stuff? He had no idea. He had no idea. He had only been sold all of the great things about indexed universal life and was going to make a decision based on that without knowing the inherent risks. God forbid. I mean, I didn't get a chance to see the policy design either, but if history shows us or teaches us anything, it probably sucks, because most policies do that we've seen. So yeah, it's just crazy. I did want to thank you for sharing that. And yeah, so at this point, what do you want to share your screen and just dive into it, or was there any other context that you wanted to provide before we do that?
Well, I'll say this: the agents that scream out it's a bad policy design, the reality is they don't design it correctly either. Like, I literally know maybe 2 other agents that do the designs correctly. And if you can understand this, it's a flexible, like, I want to break this concept down for life insurance. This is going to make everything very simple and crystal clear. People like to compare, like, even like I said, there was that post, two types of life insurance, right? And people want to compare whole life versus term, right? Like, they're 2 different things, but the reality is they're the same thing. They're the same thing, right? And so what do both policies do? They take a mortality risk, they take the cost of that, and they levelize that cost for a specific amount of time, right? In whole life, it just happens to be the whole life, right? In a term, it's for a specified number of years, right? So the only difference, they do the same thing. The only difference is how long do they do it for, right? Gotcha. And when you levelize premium, then if you're talking about a cost or something that's going to go up like that, you know, long term, that means in the beginning you are overpaying, and at the back end you're underpaying because you're levelizing that curve, right? And when you think about dividends, what are they described as?
Return of premium. Return
of premium, right? Because that is your money. You get that back and it gets reinvested. And so guess what? The same thing happens on a term policy. The difference is you don't get the return of premium back, right? The company keeps it. You don't get access to the overpayment. It doesn't go into your cash value. It's actually used as a subsidy for other policies that pay out. Because the reality is, in term, very, very few pay out, less than 2%. Right.
And term is not meant to be had your entire life. That's That's why it's called, well, one of the reasons it's called term. It's for a term, a period of time, and then to cover certain risks during that time frame, and then it expires, right? So it's going to be priced accordingly. Versus whole life, you're going to have it your entire life. Like you said, you have that level premium, whatever the level costs, but it's more upfront, but far cheaper on the back ends, but it's spread out through the entire life of the policyholder.
Yep. And so with that context in mind, understanding that there is no real difference between whole life and term, they both do the same thing. It's just life insurance. Let's take that same concept into IUL. What is IUL, right? It's a flexible annual renewable term where you can decide how long you want to levelize the premium. And the intent behind it was to be able to levelize it for 10 years, 20 years, 30 years, possibly your whole life. But then you can, it's a buy term and invest the rest concept. And the reality is why it doesn't work that way though, Matt, is because of really one word. It's commissions. Because when you buy term and then you invest the rest, think about if you bought a term policy, $1 million, that commission might be $1,200, right? But in an IUL, that commission might be anywhere from $7,500 to $23,000.
That's wild, man.
And where do you think that cost comes from? the policyholders paying that, right?
Yeah.
Bobby Samuelson. Yeah, Bobby Samuelson wrote an article on this. He actually said, for the most part, it's an artificial separation of how the policy was theoretically supposed to work and how it actually works. Yeah. And he says it's an insurmountable problem for most IUL policies. Right? Because most of them, you would need a term writer to design it correctly, to cut out that cost, to truly make it work in the way that it was intended to work. And you'd have to cut out your commissions. And how many agents do you know out there that are cutting their commissions out?
Not very many. Here's the thing, right. Like with commissions, here's the thing. I don't even have a problem with commissions. I want people to make money, and if you have a problem paying commissions, then you should probably never buy another financial product for the rest of your life. And it's not necessarily that commissions are a bad thing. It's what are you getting for it? And the other benefit is you're not directly paying for it. It's baked into the policy costs and stuff like that. But are you getting what you were told you were going to get? Right? Because you pay commission for something that's going to really set up a strong financial foundation for you. Well, yeah, I'm okay with people getting a commission on stuff like that. It's just when these things are designed to maximize the commission for the agent at the expense of the client, the policyholder, that's when it really, really becomes a problem. Not to mention too, with annual renewable term, even though you can decide if you want to pay premiums or not, you have that flexibility on how much premium you're going to pay and at what frequency and stuff like that. Those are touted as benefits, but at the end of the day, you have to be really careful with it. Like you were talking about, if you design it correctly, that doesn't really matter if the client's not funding it properly as well. Like you can design it however you want, but if you utilize that flexibility and you start messing with the funding of that policy, you can set it up for, there can be some very nasty long-term consequences from that. And because it's built on annual renewable term, even though you might not be making a premium payment later on down the road, that cost of insurance is still going up every single year. And if you're not managing your net amount at risk, man, you're really rolling the dice with your financial future for a couple of extra percentage points of potential growth over a whole life policy. Nah, I'm good. I don't see it, man. So yeah.
Yeah. Bobby Samuelson wrote an article on this and explained this whole thing, why it doesn't work in most cases. And he said the first 10 years of an IUL policy, it's more of a commission funding vehicle than it is a life insurance policy.
That's
how crazy it gets. So let me share what I saw and what you saw. And we ended up sharing this.
Can you present it again? It dropped off. No, I'll bring it on. Yeah, this is probably one of the worst that I've seen in a while. All right, let me know when you're ready.
Yep, ready.
Yeah. Okay. Yeah. You zoom in. Here, I'm going to full screen this too. There we go. Okay. All right. What you got for us?
Okay, so this is the numerical page of the policy. You can see on the side. I thought it was funny because it was called the wealth accumulate. And then you look over here on the right-hand side. So by the way, this is assuming a 6.63% interest. By the way, this is a policy with Lincoln. And one of the issues with IUL is the fact that the insurance company has levers inside the policy,
right,
where they can lower the cap rates, they can increase the cost of insurance. And Matt, Lincoln is one I've had personal experience where they have lowered the cap rates, where you literally cannot succeed, right?
Yeah, that's really frustrating, man.
Yeah,
they don't usually lower them until after you have the policy. Like, you know, one of our mentors, Chris Kirkpatrick, runs the Life 180. He calls it really a marketing expense, right? They promote the higher cap rates, and then as the policy matures, they lower those cap rates. Then they come out with a different product, a different type of IUL, and it basically just repeats the cycle over and over again. So yeah, you got to be really careful with that stuff, guys. They can change so many different things in the policy. You know, you might start with a really nice, good-looking cap rate. Is it going to stay there? I don't know. Maybe it does for some companies. I don't think we're saying like every company does this, but it's definitely possible.
Yeah, for sure. So look here, Matt. If you look at 10 years, I want you to think how this is a $500,000 death benefit. How much would it cost to get a $500,000 of coverage for a 41-year-old for 10 years?
A term policy for 10 years?
Yeah.
It's not going to be $4,000 a year.
It's probably going to
like a couple $100, few $100 a year.
Probably like $100 a month, if that.
Yeah,
right.
Not $4,000 a year.
You're talking about, let's call it $1,000 to $1,200 a year, right? And look at this, right? After 10 years, this client has paid in $40,000. By the way, no access to a single dollar the first 8 years,
dude,
or 7 years.
That is crazy. I think that's the longest I've seen an IUL policy go without access to anything, access to cash value. That's nuts.
Yeah, and it's because it was set not at the target premium, but the minimum premium.
Can I ask you something about that really quick, Michael?
Yeah.
Is there any scenario that you can think of where a client would be describing what they're trying to accomplish and you would recommend a minimum funded policy? Is there any scenario you can think of?
No. I would say this. If the intention is to stay minimally funded, just buy the term. Right. Now, can you start a policy with a minimum fund with the intention of funding it later? You could do that. But yeah, it's just understanding that, again, all the problems with IUL come in large part because of the lens and the frames that you're looking at it through, right? You're looking at it as a permanent product, and the reality is it's a term product.
Right.
And so,
and even when, if you were to start with the minimum and then go up to the max fund later or whatever target, I don't think you're setting yourself up for success with that. Like, if you have to do that, you might not be ready to do something like this yet. Maybe buy a convertible term policy, convert it into a whole life policy later. We talk about that pretty frequently. But, if you have to minimum fund the policy, in my experience, it's my opinion, you're probably not ready to do this, right? You need to build a stronger foundation first.
Yeah. Like I said, it's understanding that it's not a permanent policy, right? Yeah. And so
it's crazy that it's promoted as one, man. That's just, man.
Yeah.
It's so misleading.
But Matt, I mean, from 40,000 down to 12.9. This client is taking a $27,000 loss over 10 years.
That's so crazy, man.
That's
So,
huge. Think of the opportunity cost of that going forward, right?
right.
Think of
100%. Dude. Like, it's just, that's
that
egregious, man.
this client
That's
right here
a
alone.
lost decade. They talk
Yeah.
about the lost decade from the great financial crash. This, or is it the .com bust? Whatever. Lost decade right here.
Yeah. I want you to see something else here, Matt. I want you to look at year one. Let's look at this. So you see the net annual outlay. It says
Yep.
$4,014.
Mm-hmm.
And then the net policy value is 309, right? Now, I want to point this out because you have to understand it's an annual renewable term,
Mm-hmm.
right? Meaning the costs in the policy are going up every single year.
Mm-hmm.
And if that weren't the case, then ideally, Matt, if you were to put in the same amount of dollars for the second year plus earn a 6% interest,
Mm-hmm.
wouldn't you have a little bit more than double the next year?
You would think.
You think, right? So you'd at least have the 309 for the next year plus a 6% credit year, right? Which would, in this case, let's call it $18. 309 plus 309, 618 plus another 18. So you'd be at like 638,
Mm-hmm.
right? But look, you're actually less than double the next year.
Is that because of the cost of insurance?
That's because the cost of insurance went up.
So wild, man.
Yeah. And so that's
that right there is an extremely expensive term policy right there.
Yeah.
Is the other issue too that this is an option A design, right? Level death benefit.
It is.
Right. The 500,000 stays the same. And I believe, correct me if I'm wrong, Michael, but you make more commission on an option A level death benefit than you do increasing. Is that correct?
It not necessarily, but yes, in this case, it was minimally funded. If you minimum fund any death, you're going to make a ton of commission.
Right.
And so,
can you? One of the things I wanted to ask you, just for clarification, for those that are watching this, have just been introduced to IUL, maybe they're considering a policy, they're looking at illustrations. What is the difference there between the net policy value and the surrender value?
Yeah, so there's a charge in the policy, right? And so if you're going to do IUL, you also need to remove that surrender charge. And by the way, your agent has the ability to remove that surrender charge, right? So if they don't do it,
which means you would, if this agent had done that in year one, this client would have had access to cash value in that surrender value column, correct?
Correct. They would have had access to 309.
Right.
Yeah.
Now, why wouldn't an agent do that?
So, two things, right? Well, the reason the agent wouldn't do that, let's talk about two things that your agent, if you want to use IUL correctly, your agent has to do two things, but they won't, right? The first thing is they need to use a term rider or a term blend. Mm-hmm. What this does is it actually cuts a lot of the costs out of the policy because that's a non-commissionable term rider, right? So you can use a term rider for 75% of the coverage typically, right? Meaning if you had a $400,000 death benefit, your agent's getting paid as if he sold you a $100,000 death benefit.
Right.
Right. And we'll look at the commissions and you'll see how outrageous the commissions are on this policy. Hint, it's about $10,000. So for this, right? And so yeah, exactly. Right. And so
the only person accumulating wealth in this scenario is the agent.
Yep, and the insurance company. But as you can see, definitely not the client, right? So number one, the agent needs to remove the commissions to give the policy even a chance to perform the way it was supposed to. It was intended to perform. Mm-hmm. And by the way, they won't do that because obviously it's a 75% cut in their commission.
Sure. You're taking food off their table at that point.
The second thing you need to do, your agent needs to do, is they need to remove the surrender charge, right? Think about what makes life insurance so powerful, Matt. It's the access to capital, mm-hmm. right? It's the ability to leverage. And so if your agent isn't removing that surrender charge, you don't have access to this capital,
Right.
By the way, the surrender charge on this policy in year one is $15,000. Right.
That's insane, man.
And so in order for you to optimize a IUL, your agent has to remove the surrender charge. Now, the reason why agents won't remove the surrender charge is because a lot of times they're just trying to make a sale, right? They're trying to make a commission.
Mm-hmm.
When you remove the surrender charge, there's something called a chargeback. And what that means is in the first year, if you cancel this policy, the agent's going to get a chargeback. They're going to have to pay back all their commission that they received. Right. So the policy has to make it to month 13 in most cases. Now, when you take the surrender charge off, that liability for the agent goes to 5 years.
Really? Okay.
It does. And so that's why you're typically not going to find many agents that are willing to do that.
Is that pretty common across the board for most IUL companies or just IULs in general?
Yep. That is.
It adds
every
possibility of a chargeback for 5 years. We'll call it 3 to 5 years, whatever. Each company might be a little bit different.
Yes. Because remember, if they cancel the policy now, they get all their money back. They don't right. lose. Because remember, that surrender charge is essentially guaranteeing the commission, right? They're saying this is the mm-hmm. cost of us issuing this policy. Right. And so if you cancel it beforehand, up to that dollar amount in cash value is ours.
Yeah.
And so that's wild.
That's so wild. And just like go back to my previous question, the net policy value versus the surrender value. So the surrender value column, guys, correct me if I'm wrong, Michael, that's the amount of cash value you have access to that you could take a policy loan against. Is that correct?
Correct.
Okay.
The surrender value you can loan against, or if you do cancel your policy, that's how much you get back.
That's how much you would get. Right. Okay. So the surrender value with what we're talking about, that access to capital and using it to build wealth, the surrender value is one of the most important columns here. So if you see a bunch of zeros, but you're putting in money each year, there's a big problem. Very, very big problem here.
Yeah, 100%. 100%. And we can break this down in the cost. So let's do that. So this is the cost of the policy, right? This is typically further down. Some illustrations don't even show you this. Right. You actually have to, as an agent, in a lot of cases, you have to add it to the illustration, this report.
Yeah. Right. Michael, are you able to zoom in on it just a little bit? Can you blow it up a little bit? Yeah, there we go. There we go. Okay, cool.
Yeah. So you look at year one, and this shows where all the money goes, right? So $482 goes to a premium load, right? Mm-hmm. So there's a minimum percentage of all your premiums that there's a premium load.
And that's pretty common for IUL policies, right?
Mm-hmm.
Don't need.
Here's the cost of insurance. You see $70. Like it's not a lot, right? Because it's an annual renewable term.
And he's 42, probably in good health, right?
Yeah, he got a preferred here. Yep. He is a tobacco user, but it's still a preferred tobacco. What you see is the big one here, and a lot of times you'll see this as the per thousand charge. You'll see this under different areas here, but $3,155, right? And this is a huge charge in the policy. Yeah. And so that's where all your money's going right here.
What benefit do you get from that? What is that charge for?
Well, that charge takes care of this down here. So let's really blow this up. Do you see that, Matt, down there? TP, $8,630.
Okay. Yep.
So that's the target premium on this policy. What that means is this agent is earning on $8,630. Now, typically this is a rolling, as could be a 2-year rolling period. And that's why some of these agents will minimum fund, because it's kind of like double dipping. They can get paid for the first year commissions and the second year commissions at the same rate. But typically your agent is probably making between 120, 150% of this, right? So when you, even at 120%, you're talking about a $10,000 commission.
Right.
So where does that come from?
He got paid for $8,600 of premium, but the client's only putting in 4,000. What's the discrepancy there? Is that an example of the minimum funded, like minimum funding a policy?
Yeah. So minimum fund, and typically, right?
He could put 8,600 in per year if he wanted, right?
Yeah, he could actually put a little bit more than that. I think this one was almost 10,000.
Right.
He could put
But
in.
they've set it up here where he's starting as $4,000 per year.
Right. Right. And typically, when you sell at a target, let's say it's a target premium or a target funded policy, you're, as the agent, you're going to earn, say, that 140% on the first year commission, right? After that, you might earn 2%. But by doing it this way, a lot of these companies, what they have is a 2-year rolling period for you to meet the target premium. So now, if this client's budget was only 4,000, he's not only getting paid on the first year 4,000. He is getting paid on the second year 4,000.
Yeah. Up front, right?
It depends. Some of these companies advance, some of them don't. So it could be pay as you go.
That's crazy. So then at year 8, it looks like that drops off, right? That it goes down pretty significantly. So why is there such a significant drop in those charges at year 8?
Yeah, so that's when
getting out of the period.
Yeah, so a lot of these companies. So I'll use a more common phrase, the per thousand charge. A lot of these companies will illustrate this charge maybe for 10 years. However, contractually guaranteed, they can charge it all years, right? And so what these companies do is they actually they have a current assumption of how long these charges will be on the policy. And what that does is it allows them to illustrate without those charges going forward. In like in years 11 through 20, you see the cost of this policy is a lot smaller, right? It allows them to illustrate that. But remember, contractually guaranteed, they could choose to charge that all the way through the policy all years.
Sure.
Right. And that's what a lot of these
lever they can pull.
It's a lever that they can pull. And so you don't actually know what you're going to get. It's one of the reasons why these policies, it's like a minefield, Matt. I tell people it's like a minefield. You really don't know unless you're really good on the inside. You familiar with these companies,
right?
And the reality is when you think about how many agents are, this is an industry where 92% of agents fail in their first year and they're out. So already that brings you down to about 8%, right? And then I would say I started learning this stuff about 4 to 5 years, about 4 years into my career. So you think about how many agents start to notice like, hey, these numbers aren't what I thought they were. Right.
Yeah, something's wrong here.
Something's going on. Yes. I need to learn more. And then, by the way, Matt, how many agents do you know that you make aware of that and they don't want to hear it?
Oh yeah. I get some pretty interesting comments on it.
Yeah.
Lots of it turns into a personal attack. Like I'm coming after their character or something because I'm calling out this crappy product, you know? A lot of them don't take it very well.
And Matt, the reality is when you understand only 8% even make it past the first year, then you go 4 years out, right? It's even a smaller percentage. And then you have to cut out all the people that don't want to hear it, all the people that are just remain ignorant. You're talking about less than 1% of agents that actually know what they're doing.
That's so dangerous because there's probably hundreds of thousands now across the country selling this stuff, especially like the big MLM companies for financial services and stuff. And there's just so much of it out there. It's ridiculous.
Yeah.
So what is
this Matt is this is the part of the illustration that they all skip over, right? Non-guaranteed elements. This policy contains non-guaranteed elements and index account non-guaranteed elements. NGEs include cost of insurance rate, policy value charge, administrative
which is what
charge.
You're just talking about. Yep.
Yep. Administrative charges, premium load, interest rate credit to the fixed account, interest rate credit to the holding account, interest rate credit to the dollar cost averaging account, and the account value enhancement rider. See the index account section for the list of the index account NGEs applicable to each index account. Basically, what they're telling you right here, Matt, is every single piece of this policy is flexible.
Yep, it's basically up for renewal every year.
Yeah.
Do we want to keep it the same? Do we want to change it? Maybe sometimes in your favor, sometimes not. And here's the thing, guys, it's what they need to do in order to manage risk because of the option strategy involved with this indexing, with the indexing interest on an IUL. There's so many different elements involved. You have the cost of call options, you have the call option budget. You have your rising cost of insurance. There's so many things, so many levers that they need to be able to pull in order to manage risk, and that you suffer the consequences of that. The life insurance companies still do good. They still do really good, but anything in your policy can change. And like, if you were to go into business with somebody, you sign a contract and you're putting up all the risk, right? But your business partner has the right to change the contract. You can't change the contract, but your business partner can change the contract at any time in order to benefit your partner. Would you get into business with them signing a contract like that? I wouldn't. That doesn't make any sense to me. But you're seeing it right here, okay? Right in this is part of the illustration, right, Michael? It's right in the illustration. Yep.
This is on page 4 of this illustration. I just didn't show the whole illustration because I didn't have the time to go through and take the client's name out. So, but
it's there. All these things can be changed.
Yeah. So if you look, by the way, Matt, look at the second paragraph, and we'll end it as far as this goes here. But we may make changes to each of these NGEs and index account NGEs as described in the policy. Such changes can be made in consideration of one or more of the items listed in the policy. A change to one or more of these NGEs and index account NGEs can affect your policy's performance, including coverage duration and premiums required to keep your policy in force and surrender value. So they're right there. When you say including coverage duration, what does that tell you, Matt? It's not a permanent policy.
Not permanent. Yep. That's it's very dangerous, man. And I've seen so many stories of that where people thought it was a let me back out of here. Thought it was a permanent policy. Like these like the traditional universal life policies. People stopped making premium payments at one point, just thought it would always be there, and they'd be able to pass on this legacy to their loved ones. And all of a sudden, they're 90 years old, they get a bill for $12,000 because all their cash value is gone. And if you want to keep your policy in force, here's what you need to pay us. And it's a lot of the times it's too late to do anything with it by the time people figure out that, hey, this is not what I was presented. And then I'll hear agents say, oh, well, that's traditional UL. IUL is so different. No, actually, it's not. The only difference is the interest crediting strategy. That is literally it. It's still built. It's indexed universal life, guys. It's built on the same chassis. It's built on annual renewable term. It's just a fancier interest crediting strategy. And I don't know about you. I don't want to bet my hard-earned money on this unproven, really untested product. I mean, it hasn't been around that long. I don't think, Michael, you've been doing this longer than me. I don't think we've ever seen a successful policy, like people actually taking retirement income from it and like having it perform as illustrated originally. Like, I haven't seen it. Have you?
No. I mean, reality is this is a product that got popular in 2009. We barely had enough time to go through a proper funding period, and accumulation period.
Right.
And that's the reality. But when you look at the history, you look at the UL, right? I've definitely seen a lot of those lapse.
Yeah, not a good track record, guys, at all. So what I'd like to wrap up with, Michael, is just your thoughts on. So, given that policy that they set up, what would the future of that policy look like? So at the 6.63% illustrated rate, which it's probably not going to do that because it credits that every single year. But with a policy like that, where there's like zero surrender value for like the first 8 years, do you see that policy surviving very long? Do you see that policy surviving or doing anywhere close to what was illustrated as the policy matures?
No, typically what these types of setups end up looking like, and by the way, this is assuming a solid interest credit, right? But typically what I see is these policies are going to end up being kind of like a very expensive 30-year term policy.
Yeah. And it's not going to provide all the tax-free retirement income they say you're going to get. And lastly, what would be the client's option in this case? They've because correct me if I'm wrong, I think you mentioned that this is a new policy that the client set up, right? So as you explain this to the client, what's his option? What can he do to rectify the situation here?
Yeah, it's time to walk away from the policy.
So he just eats the cost. And consider it an expensive learning lesson. So you wouldn't be able to, 1035 exchange it or anything like that?
There's zero surrender value. There's nothing to exchange. Yeah. There's nothing there.
So you take the hit, take it on the chin, learn your lesson and move forward. I guess a more positive perspective on that would be, he paid, assuming he's just done the 1 year, I paid $4,000 to avoid $1 million mistake, or I'm exaggerating here, but after 10 years, he put $40,000 into it. So he paid $4,000 to avoid a $40,000 mistake. It could have been worse. Like he may not have learned about this for a very long time after he's put hundreds of thousands of dollars into it. So I guess in the long run, a small price to pay to avoid something like this, and you make it up from there.
Luckily, I told the client we got some good news, and that's that. Luckily, it's only been 9 months, so he's put about a little bit over $3,000 into this policy.
Gotcha.
Good news is it's not 5 years in, and it's not $20,000.
Right. And he did have coverage for that period of time. Granted, very expensive coverage, but he was still, financially protected with the death benefit. So there's that benefit. But yeah, at the end of the day, guys, a lot of the times this is my biggest frustration with this stuff. Michael, I think you're the same because I believe you actually do sell IUL sometimes. There are some cases where an IUL might make sense. And obviously there needs to be proper design and funding and stuff like that. But I think that the biggest frustration about this is not necessarily the IUL, the product, it's the marketing, it's the agents, it's the false advertising, the misleading nature of what's being presented to people. And it's served up on this silver platter as this amazing miracle unicorn financial product that's going to give all these benefits to you. But they sweep all the risks under the rug, all the things that can change, all the things that can go wrong. They just brush those to the side, don't even tell people, or they'll sugarcoat it. They'll downplay it, like, not a big deal. That rising cost of insurance, you don't need to worry about that. Those whole life agents are crazy. They don't know what they're talking about, right? And they downplay all this stuff so that you'll buy it because they make a ridiculous amount of money on it. And yeah, we get paid commissions on whole life policies. That's fine. But I lower my commissions very significantly when we design them the way that we do, because again, it's about doing what's right for the client, not what's going to put the most amount of money in your pocket. Like, it's just ridiculous, man. So at the end of the day, guys, I want you to be careful. Please, please, please do your research, understand how these things actually work. If it makes sense to you after you know the risks, go ahead. You're an adult, do whatever you want. But don't make uninformed decisions because it can have devastating long-term consequences. So, Michael, I appreciate your time. Any final words? Anything else you want to share?
Yeah, Matt. You mentioned I do sell IUL. I believe there's 3 ways to sell IUL and have the proper expectations and have the policy do what you want it to do. It sounds like another video we got to shoot.
That would be a really good one. I'm actually genuinely curious because, you know, and I'm a little biased when I say this because I've only really seen the bad side of IUL. I don't see any real strong case for IUL, but I'm open-minded. Like I know at the end of the day, it's just a tool. It comes down to how you use it. It might fit in some scenarios. So yeah, I would love to do a video like that. So let's do that. We'll set that up for next time. And when we do that, guys, I will link that video down below. So just make sure you subscribe and leave some comments down below if you want me to send that to you once we have it done, and I'll send it over. I think that would be really good. So Michael, as always, a pleasure. I will link down to Michael's YouTube channel down below. His company is IC Life. It does really good stuff. Michael, you do whole life insurance, IULs, annuities. You help, you know, basically just create a really holistic financial setup and foundation for people. So if you guys want to reach out to Michael, I'll have his information down below as well. So, but always a pleasure, my friends. Really appreciate your time and look forward to the next one.
Yeah, appreciate it.
All right, man. Take care.